Hello everyone and welcome back to another episode. My name is Jordan. I'm a millennial investor and today we're talking about the dividend growth portfolio. We're hopping in M1 Finance, and in this M1 Finance dividend growth portfolio we made some small changes today, specifically with three different companies. The first one, as you can probably tell from the title of this video, is JPMorgan Chase. The second one is Vici Properties, a real estate investment trust company that we just lowered in the portfolio, as well as an increase to a third company, which is Procter & Gamble, ticker symbol PG. And these are the three companies we're going to talk about today. I increased JPMorgan Chase and Procter & Gamble up 1% and took down Vici Properties 2%. I am not recommending selling Vici Properties. I just want to lower the target weighting from 8% down to 6%. And the updated portfolio will be in the description, so check that out down below if you want to follow on with this portfolio or invest it in yourself. It's not financial advice, but if you want to check that out down below in the description, as well as sign up for M1 Finance or anything down below, including Yada savings accounts, credit card referrals, all that good stuff, that is down below. But let's go ahead and jump into JPMorgan Chase. I mentioned this in a previous video. I made a video just a couple weeks ago about JPMorgan and why I think it's a great company. Now let's go ahead and start off by looking at this stock. JPM stock has really had a tough time in 2022. Year to date, even after this slight recovery, it's still down 22% on the year, which is not good at all. And a 1 year performance, it's down 23%. 2 years, it's up 19%, and on a 5 year, it's only up 32%. Now, I know 32% is a decent return, but when you look at over a 5 year period, that's quite low considering that the S&P 500, if we load up SPY here and look at the 5 year performance of it, it's up 74%. So JP Morgan has been lagging the market quite a bit. Now, this doesn't factor in dividends reinvested, so it does factor in a little bit more than that, but still 32% over the last 5 years is not very good. And if you look at this valuation metric, which is the most common for valuations of bank stocks and financials in my opinion, because if we hop over to Qualtrim here, normally what I'm using is I'm looking at this, and we will use this here in a second, but the main thing that we typically look at are things like price to earnings ratio or price to sales or EBITDA to free cash flow. Lots of different things like that we can look at that can help value companies, right? But price to book is normally the best for financials, and the higher this is, the more overvalued it is, and the lower it is, typically the more undervalued it is. Now you can see that generally JP Morgan has floated around a 2, the high ones, 1.8, 1.9 over the last year or so, and now as of today's current trading price at 123, it sits at a 1.4. So the company's come down in valuation, and then the revenue has continually trended upwards. You can see that it's going higher and higher, and then the net income, while it is a little bit off of its record from those ridiculous numbers that were put up in 2021, it is still basically on an uptrend. You see this upwards movement ever since the lows here. It has typically gone upwards. And if you look on an annual basis, you'll see a similar story with its dividend as well as its cash balances, which is at an insane $1 trillion. So that's also customer holdings, of course. But overall, if you look over the year-over-year charts, it's doing the right things. It's going in the right direction, and you're seeing the correct things that you want to see when the business is going great and the stock prices is going down. So when you look at a chart like this year to date, this is what gets me excited. Down 22%, but the business is pretty much as safe as it gets, and it's at record levels. That's incredible. That's something I want to invest in, and so that's why we're making it the largest holding in the portfolio. And the fact that now it has a 3+% dividend yield, and it's likely to raise that dividend soon based off the streak that we've seen in the past, I think now is probably a decent time to be adding. And when you compare this to the other one that we're going to be taking down in the portfolio, which is Vici, this is a great company, but the problem is that it was originally extremely undervalued on a price to AFFO ratio. The price to AFFO is reasonable now considering that it's a REIT when you compare it to its competitors. When you compare it to a company like, say, Realty Income, or if you compare it to a company like WP Carey or lots of its other competitors that are very similar, when you compare Vici to those, it's now pretty much in line when it was trading for a pretty steep discount for a long time. And part of the reason, as you can tell, if you look year to date, while the stock market in general, let's look at the S&P 500 again. If you look year to date, this is still down almost double digits, 9.7%. But what is Vici doing? Vici is currently up 18% year to date through all this turmoil, and it does almost a 4% dividend yearly. So when you factor that in, it's more like this company's really up about like 20+% on the year when you factor in dividends. And this company has finally started to come alive. It's finally started to revive out of the hole that it was back in 2020 and during the nasty dilution days when investors were scared about getting diluted from the big deals and acquisitions that they were doing. But now the company's doing great on a 2-year period, up 55%, and the business is still great. It's still a quality business. And that might be leading you to ask, okay, well, why are you lowering it? Well, the reason is it's gone up a little bit too much, and I want to focus on other holdings. It's not that I'm bearish on Vici, but I want to focus on investing in holdings that I think are more undervalued, like a JPMorgan that's very defensive with a great yield. Furthermore, Procter & Gamble, if you look over the last year, it's basically flat, up 3%, pretty much went nowhere, and it's basically been in this no man's land of not really going anywhere over the last 2 years, only up 9%. And the thing is, this is one of the core holdings. There's a couple of these holdings in here that I likely never intend to sell. Procter & Gamble is one of them. A couple of them, like for example, Coca-Cola, Procter & Gamble, Home Depot, Pepsi. There's a couple of core holdings in here that I'll probably just flat out never sell. So when you factor in the fact that Procter & Gamble was a 1% target weighting before this, that is extremely low for a core holding. I did sell it off to take advantage of some other holdings while the company was originally at 160, 170, 150, and I thought it would be smarter to move capital to other positions, which I did, but now that you consider the fact that you're taking it up to 2%, you're starting to get a little bit higher, still a long way to go to get it back up to its 4, 5, 6% weighting that it used to be, but it's starting to creep up and I want to build that position back up because it's frankly just too low. So Vici, there's nothing against it. I want to take it down, but more importantly, I want to focus on getting JPMorgan up to a higher percentage, up to the largest position in the portfolio, which now it is, at a whopping 10%. We finally have one in the double digits. So once again, just to reiterate, this is nothing bearish against Vici. I don't think you should sell the company, but I know that one of the big bullish catalysts that I had going into 2021 for this company was getting in the S&P 500. And that's great, but that's already happened, and now investors are really excited, and they're pushing this company up from 28 to 30 to 32 to 34, now $35 a share, and even today, just barely a red day when overall the markets were pretty red today. So Vici is a company that I like. I still want to hold on to. I won't be selling anytime soon, but it's just one that I'm not as confident on. I'll keep you updated with any holdings in the portfolio. As always, I show my portfolio holdings as well as my performance that I have in Fidelity. This is year to date, which fun fact I want to just mention very briefly, I broke $40,000 in portfolio value. I update this chart right here monthly, and so as of August 1, it was $33,000. After today's close, which I'm filming this on 8/16, which is 15 days later, we broke $40,000. $40,300 was the close of today's price, so I am massively excited about that. I've never broke $40,000 in the portfolio before, so it feels good. I'm excited, and hopefully we can eye towards, $50,000, $60,000, $100,000 one day, so I'm pretty excited about that. But overall, guys, thank you so much for watching. I hope you found value in this video. I just wanted to give you a quick portfolio update. If you want to make the changes to yourself, that's great. Feel free to check out everything down below in the description like always, including Yada savings accounts, credit card referrals, and then of course the referral to M1 Finance, which 124 people have signed up to so far. But thank you guys so much for watching, and I'll catch you guys next time.